Good morning. Welcome to Wilshire Finance Partners 2025 Performance Review and our 2026 Outlook and Allocation Strategy. When looking at the attendee list this morning, I noticed that we had a pretty good representation and cross-section of individuals that are joining us today. We actually have some investors that have been with us and invested in the fund for over a decade. And welcome. We appreciate you and thank you for entrusting us with your investments over the years. On the other end of the spectrum, we also have investors that have just invested in the fund, brand new. Thank you. And again, we appreciate you and thank you for entrusting us with your investments. We also have folks that are just taking a look at Wilshire. They're exploring the potential opportunities and they're probably looking at other alternative investments as well. So welcome. Hopefully we're able to answer at least some of your questions today. That's the goal. And so with that, I'd like to give those newer people a little bit of an overview of Wilshire. We're a real estate finance and investment company. We were formed in 2008. Our focus is short-term alternative investments, specifically real estate-based private credit and private equity. My name is Don Pelgrim. I am the Chief Executive Officer of Wilshire Finance Partners, and I'm also the manager of the WFP Income Fund, the WFP Income Fund REIT, and the WFP Opportunity Fund. I'm an attorney, and I'm a former banker. And this presentation is for you. We want you to participate. We want you to ask questions, but we will be covering a lot of materials. So I'm going to hold my responses until the end of the presentation, and we may just answer a few of those questions along the way. So with that, let's jump right into it. Oops, a little bit of technical difficulty here. Okay, a little bit of housekeeping. Um, this presentation is for educational purposes only. It's a summary. It's not going to cover all the risks and rewards of investing with Wilshire Finance Partners. It's not legal, accounting, or investment advice, and it's not an offer to buy or sell securities. We will discuss the historical performance of the fund, and past performance is not indicative of future results. And certain statements that we're going to make are forward-looking and will be subject to change. All investments involve some level of risk, so you're encouraged to investigate and review both the risks and rewards prior to investing. So what are we going to cover today? Well, we're going to do a 2025 performance recap, and what you'll see throughout this presentation is risk management will be a running theme. We'll touch on the WFP Opportunity Fund and how we're repositioning the fund and changing our approach within that fund. We'll talk about the market conditions. We'll talk about our 2026 allocation strategy, and then we're going to open it up for questions. So generally, how was 2025? Well, like prior years for us, 2025 was about maintaining lending discipline. It was seeking and driving new opportunities for our funds, but not being overly aggressive. Our focus remained principal protection, but also generating good risk-adjusted returns for investors as well. Now, what we did see was some market volatility, not only in the stock and bond markets, but in the real estate markets. There was some choppiness or unevenness in real estate. And what we saw was that there were certain sectors that were better performers and other sectors that were underperformers in the marketplace. With respect to the better performers, senior housing continued to demonstrate strong resiliency. And a lot of that is driven by the demand for senior housing and a lack of supply. In other words, there are more people looking for beds than there are beds available in a lot of situations. And we expect that to continue over the next several years. In multifamily, that continued to be one of the strongest and more resilient sectors in the marketplace. And that was because of the housing shortages and higher mortgage rates that kept many people as renters as opposed to being buyers. And we saw that transition and impact single family as well, where similar to multifamily, the driver was sort of a shortage of that affordable housing and higher mortgage rates. With respect to warehouse and industrial, still good performance, although growth started to normalize a little bit. Drivers continue to be e-commerce demand, supply chain onshoring, as well as last mile distribution. Last mile distribution is getting closer to the end user of your product. Data centers and digital infrastructure, one of the fastest growing sectors in the real estate market, driven by AI and cloud computing demand and their need for massive data storage requirements. Self-storage continued to perform well, and we saw a good performance in medical outpatient facilities. A lot of that was driven by cost reduction strategies in healthcare generally. The stuff that was a little bit more middle of the road or underperforming was retail. Now, retail kind of surprised a lot of investors with its resilience, and there were some strong subsectors in the marketplace, including grocery anchored centers and experiential retail. What's interesting is there was a little bit of announcement this morning that grocery outlet is actually closing 36 stores, and that may impact some of the CMBS bonds. So what we're seeing is that in retail, it's really driven by the subsectors as opposed to retail generally and specific properties. Underperforming properties or mixed segments included office, which was the most challenged sector of the marketplace. High vacancy, a lot of which had to do with hybrid work or downsizing of the total amount of office space people need. And there was a gap between sort of your A or prime properties and your older assets, with the older assets being the more difficult ones. And hospitality was a little bit uneven, really depended on how people were traveling and where they were traveling to. And we saw, some refinancing pressure and selective liquidity. And what I mean by that is that some lenders either stopped lending in certain sectors or curtailed what they were doing in certain sectors. So, for example, land development and ground up construction, there wasn't a lot of capital going into those types of requests. Although we are hearing that construction lending may come back a little bit more strong in 2026 and 2027. Multifamily had selective liquidity, and not necessarily because of the sector itself, but deals were a little bit tougher to pencil because of the higher interest rate environment. And what was occurring there was that capital was a lot more cheap and a little bit more free flowing a couple of years ago. And for assets that were looking to refinance in a higher interest rate environment, became a little bit more challenging in order for those deals to underwrite. And then retail, as we said, because of the mixed sort of performance of that particular asset class, there was selective liquidity there as well. And what we did see was that there was a capital flight to more quality type assets, and we were seeing more capital going into stronger sectors. So the ones that had the strongest demand included data centers, digital infrastructure, multifamily housing, industrial and logistics, as well as senior housing. And then again, the weaker sector being office as well. So how did the WFP Income Fund do in 2025? Well, for the people who are new, the WFP Income Fund is a real estate debt fund that focuses on lending and investing in first trust deeds and mortgages at lower loan to values. And the fund is designed to deliver a balance of stable income and principal protection. In 2025, the fund delivered a 9.01% net annualized non-compounded return, and that was the amount paid to investors net of costs and expenses of the fund. Strong portfolio performance. All loans performed well. We didn't have any non-performing loans or REO on the balance sheet of the fund. Another cut at the fund. It delivered a 6.88% net annualized non-compounded return since inception. Inception being September of 2013. We see a little dip in 2020, and that was not a result of losses, but we increased our loan loss reserve during COVID. Loan loss reserve is a concept where you set aside some of the interest earnings or the capital of the fund as a protective measure, sort of like a rainy day fund, to help buffer against potential losses in the fund. And then, as you see, as we emerged out of COVID, rates started to return, and by 2025, a little bit over 9% annualized in that fund. 10.54% net annualized compounded return since inception. Again, that was September 2013 through December of 2025. Now, the downside risk protection in that fund is not theoretical. The balance, again, of the income fund is the balance of that principal protection and the returns that we're seeking there. And it's really by design in terms of how we approach risk management. We use a more conservative lending approach where you've got shorter duration loans in the fund, and we're just investing in first liens. So when you're looking at this slide, and on the left here, you'll see a weighted average maturity of 26 months. Why that is important is that the shorter term loans give us a real-time look at the real estate market and give us the ability to make underwriting adjustments on the fly, so to speak. And it also creates some internal liquidity within the fund. On the other side of the slide there, you see just over a 60%, close to a 61% weighted average loan to value. Well, the inverse of that means that we're just about a 39% protective equity cushion. Well, what does a protective equity cushion mean? Well, it's important because it helps to protect an investor's principal investment in the fund. It helps to protect against downside risk because the borrower has, quote unquote, skin in the game. And it also helps to buffer against changes in property value. So on this slide, I've got a hypothetical property worth $1 million. And let's say we make a loan of $650,000 against it. So we're at a 65% loan to value, and starting out, we have a 35% protective equity cushion. Well, if property values drop 20%, we still have $150,000 as a protective equity cushion on a property worth $800,000, and there really wasn't any impact to that investment in the fund, that first trust deed. The loss went to the borrower's equity, not to the loan that was held in the fund. So that concept translated into a stable net asset value over the years and since the inception of the fund. But again, the fund is about balance. So the best part is that we're able to maintain that stable net asset value. We've been able to do that over the years, but also deliver a nice risk-adjusted return as well. So what are we seeing now, and what are investors asking about in 2026? Well, investors are still interested in strong returns. However, it's now about understanding the risk and the drivers of those returns in different investments. So for example, how has that investment performed? How has it preserved capital in various different cycles? What is the quality and the consistency of the income coming from that investment? How does the manager identify, think about, and manage risk? And the question also starts to circle around liquidity. In other words, if I'm in the marketplace and I have instant liquidity because I can sell a stock or a bond, are there better quality investments out there that may outweigh that liquidity trade-off? And some of that ties back to the thought process that investors have had. And there was a study that was done a couple of years ago by Capgemini And in that study, it was determined that Americans hold as much as 20% in cash in their portfolios, and that's on top of other liquid investments. And then that same study looked at high net worth individuals and determined that up to 70% of a high net worth client's assets are in illiquid investments, including hedge funds, private equity, real estate, private funds, business interests, and other alternative investments. And again, looking at the group of people who are on this call, there are a number of people who fall into this next category. And in that same study, they looked at the concept of held away assets. And those are assets that are investment opportunities that high net worth individuals identify, select, and make on their own because they're not getting access to alternative investments through to traditional investment providers. So all of that started to beg the very personal questions, such as how high is high enough, and how much liquidity do you really need to have? And is a liquid investment better, or is a better investment better? And are investors getting access to the alternatives that they need for consideration? So those are the type of questions that we're starting to hear in 2026. So how are we thinking about deploying capital? Well, the cornerstone philosophy for us doesn't change. It's about quality over quantity. And that has served us well over various different economic cycles. It's a conservative approach, granted, and that involves considering the borrower, the sponsorship, the nature of the investment, the risk return balance, how we structure those investments. For example, is there a clear, realistic, and viable exit or repayment strategy? And it's maintaining that disciplined approach. It's being selective and not chasing yield for yield's sake. And it goes back to an old banker's axiom: you can't make up for a bad investment through yield. So you might have a 15% coupon or the promise of a 15% return, but if the borrower's not paying you, well, you're not getting 15%, you're getting something far less than that. But why does private credit feel a little bit different now? We're seeing a lot of capital investing in private credit, and that's because of the benefits. And I used to say when we started out, we were investing in private credit before it became really sexy. But we're seeing other people coming in now, and that's because of the sort of the general benefits that we see, such as the ability to avoid volatility and market risk. For example, we're not exchange traded, so we're not subject to that market risk. And sometimes that market risk is driven by things that are not connected to the fundamentals. It could be rumor, innuendo, speculation, a variety of different things. Private credit can, if structured properly, avoid some of that. It's the quality and the consistency of the income. It's not driven by market sentiment or changes in dividend policy. For example, in our fund, we have mortgages. So we've got contractual mortgage payments, which help to deliver that more consistent cash flow. Little to no correlation to the stock or bond markets or interest rates. Now, we will see changes in the returns of the fund, but that's different than having an inverse relationship between a share price and what's happening with interest rates. As we saw, the fund has been able to maintain a more stable net asset value in spite of changes in interest rates. So little to no correlation to that. And then liquidity, again, that liquidity versus illiquidity trade-off. Our fund has a 1-year hard lock and then the ability to redeem monthly. And we believe that that's a prudent approach. And investors, when they're looking at that market risk versus liquidity and looking at that trade-off, sometimes they're going to assets that might be a little bit more liquid because it creates a little bit more overall stability within that underlying portfolio. So again, gets back to those very personal questions. So what are we seeing in the market and in our pipeline in the WFP Income Fund? Well, private credit to some degree is like a market barometer. When there are changes in conventional lending or access to credit, that leads to greater demand for private credit. But all demand is not good demand. Sometimes it's like being a canary in a coal mine where, we're seeing deals that are off the mark in terms of what we want to look at. So, for example, we saw an uptick in requests for land development and ground up construction, financing offices, financing retail, financing hospitality properties. However, those are asset classes that we don't lend into or don't lend against. So therefore, it continues to involve the positioning of our fund in the marketplace and maintaining discipline to look for those deals that we wanted to see. So what we saw in 2024 was a nice increase in the fourth quarter of 2025 in the WP Income Fund. In fact, we saw 551 loan requests, which is a pretty significant number. In the first couple of months of 2026, that slowed down a bit, but then we saw it pick up again in March, and we're actually outpacing the number of inquiries just through yesterday as compared to the fourth quarter of 2025. And that increase in requests do involve sectors that we do want to lean into in finance. So we're seeing senior housing transactions, including acquisitions. We're seeing recapitalization requests. Now, some of those recapitalization requests fall into different categories. So when timelines lengthen and there's additional capital that might be needed, we look for investments where the borrower has demonstrated that they've got strong income, but they need a little bit more time to continue with their plan. So in other words, they need a little bit more time or runway. Conversely, there are other requests where they're burning cash, they're not turning a corner, they're continuing to struggle, so they need bailout or rescue capital. So those are the type of deals that we avoid. We are seeing capital restructuring where you've got a strong operating facility, and what they're trying to do is restructure their debt and equity, so pull a little bit of cash out through our financing prior to going to longer term financing like HUD financing. So we're seeing some of that occurring as well. In the multifamily sector, value add acquisitions, and we're seeing a few off-market transactions where the buyer and the seller are getting together because they know each other in the marketplace and not necessarily having a realtor involved in that, which is pretty interesting. However, as we said earlier, sometimes the bid and the ask, or what the seller is looking for and what the buyer is willing to pay, there's a little bit of a spread. And as that comes closer together and hits the right benchmarks, then those become a little bit easier to pencil on the lending side of things. And in the warehouse and industrial sector, we are seeing strategic acquisitions where businesses are looking to expand and they need additional space. And we're also seeing some of those recapitalization requests, but a little bit different than the senior housing type deals. And usually those involve the borrower looking to tap into some of the equity in that warehouse property to use that for additional business expansion. So they're forward looking there. So the result is that we're seeing more deal flow coming to the income fund, and we anticipate additional portfolio growth in 2026. Now, to this point, I've been talking about real estate private credit, and I'm going to pivot the discussion and start to talk about other private real estate investments. And we're going to talk about the WFP Opportunity Fund and the strategic shift that's occurring there. Now, with all the talk about being conservative and how we manage risk, why the shift now with the WFP Opportunity Fund? Is that at odds with what we just said about the income fund? Well, it's really not, and here's why. The Opportunity Fund is evolving to meet demand. Borrowers and sponsors are looking for different forms of capital than what we were previously providing. They're looking for mezzanine financing. They're looking for equity. And then we've got investors that are both in the fund currently, but also investors that are looking at the fund that have different investment objectives. They're looking for higher returns and have higher return expectations. And goes hand in hand with that, they've got higher risk tolerances and longer term investment horizons. But what the shift doesn't mean is that we give up prudent lending and investing principles. What it does mean is that we're aligning the fund with the fund's original mandate and objective, and that's seeking that higher return, but it's that risk reward balance that we're seeking. And we're designing this so we can meet the demands and the desires of the borrowers and investors. So what is driving some of those decisions with the fund? Well, it's market reality. We're adapting and adjusting to what we're seeing in the marketplace. Again, the forms of capital that are becoming more attractive. We're seeing more capital entering the market, making some other forms of capital less attractive. It's seeking that higher return potential through different forms of capital and different types of capital deployment. And that shift again aligns with the original mandate of the fund and what we're seeing in a changing marketplace. However, all capital and all investments are not the same. So higher return potential also means that there'll be changes to the portfolio composition and changes to investment complexity and how we manage risk. And the goal here is to ensure that it's suitable for the investors that are in the fund and investors that are looking at the fund. So it's striking the right balance. That's the overall objective of doing this. So now that we're making these changes, what are we seeing in the marketplace and what are we seeing for the opportunity fund? Well, we're focused on relationship-driven engagements or programmatic capital, where we can be a consistent capital source and provide execution certainty for those partners that we're looking to align with. And it's about efficiency and ease of use of our capital. Providing flexible capital structures and approaches, including equity and JV type arrangements, in addition to subordinate liens and mezzanine financing, and focusing in on different asset classes. But those asset classes generally align with the asset classes that we've identified that we like to be in. And the primary focus out of the gate is really on residential and seniors housing. So with respect to our marketing and development, we are focused on and reaching out to existing relationships to let them know that we've expanded our offering. And we're also reaching out and developing new potential channels for deal flow. And while still early in the process, it's definitely moving in the right direction. In some instances, we're beyond that introduction of our offering, and we're now educating people on the types of deals that we want to see. And as we're seeing deals, we're refining that and saying, no, that's not what we want to see. This is more in alignment with what we will do. And we put out term sheets on a few deals. And again, it's that relationship development that we're focused on. So we're starting to see more deal flow for the Opportunity Fund. We're starting to develop those relationships. And again, we believe that that's going to translate into portfolio growth in 2026. So what will be guiding our decisions in 2026 and beyond? Well, it depends on the investment approach, the fund, for example. So for example, with the WFP Income Fund, we're still focused on delivering stable income and principal protection. It's still designed to be more conservative. It's designed to help investors get income, clip a coupon. That's the nature of the income fund, so more of the same there. With the Opportunity Fund, designed to be more opportunistic, seeking higher risk-adjusted return, and layering in additional capital approaches and structures for the Opportunity Fund. But within those approaches, we're still going to focus on our core principles, which is a disciplined approach to how we're looking at transactions and how we're deploying capital, transparency in our interaction with people, including our investors, like these types of communications, as well as the people that we're deploying capital with. maintaining prudent underwriting and structuring of the deals and driving those relationships. That's really the primary focus as we roll forward into 2026. So with that, what I want to do is open this up now for questions. Okay, are you seeing more attractive lending opportunities now than you did a year ago? And what does your pipeline look like going into 2026? Well, we certainly saw a pickup in um, inquiries in the fourth quarter and in the first quarter of 2026. So yeah, we are seeing a pickup across the board. We're doing a lot of vetting of those transactions, and we anticipate that we're going to see growth in both the pipeline and in the portfolio in our funds going into 2026. All things being equal, if that level of inquiries and the level of deals that we're seeing remains the same. Let's see. What specific steps did you take in 2025 to protect capital in an uncertain market? Well, throughout the years, we've had the precept and the principle, the guiding principle of really looking to protect the investor's principal investment first and foremost, and also looking for those attractive returns within the fund. And being disciplined means that sometimes you're passing on transactions, even though you might be sitting on cash. So it's maintaining that kind of approach. We will continue to do that on a roll forward basis. Again, it's going to be more quality over quantity, and we want to make sure that we're putting strong assets in the fund at the outset. And when you're really looking to mitigate risk, it's not when that transaction is already on your balance sheet and something goes wrong. It's actually mitigating risk before you actually make the deal. It's how you go about your underwriting. How should investors think about the role of the income fund in their portfolio today? Well, I think that the income fund fits into an overall allocation strategy. And what investors typically do is they look at the short-term fixed income portion of their portfolio, that particular sleeve. And in that sleeve, they'll have different types of investments that might have a 1 year duration, for example. So that's where a lot of our investors are putting the income fund inside of their portfolio. It's that short-term fixed income investment. They are looking at something that's going to be a little bit more conservative, that's going to have a little bit of more downside risk protection for them, but it's going to generate a little bit of a higher return relative to some of the other short-term fixed income investments that they've got in their portfolio. With the high water and electrical requirements for data centers, what is your prediction in the future and/or elimination of water electrical needs to reduce risk? Well, it's tough to predict. I mean, it depends on where you are in the country with respect to water and data requirements, frankly. I mean, if you're in certain states where water is at a premium and you're in a sector of that state where it's tough to get access to that water, it's going to be difficult. I think that there's going to be alternatives or alternative means that are going to be needed for both water and electrical requirements. Some of that might be how the water infrastructure is currently in place and how that needs to be adjusted. So, for example, in California, we say that we've got a water problem. Well, what we've got is a runoff problem to some degree. And, if the infrastructure is changed, and the aquifers are able to capture more of that water, then there might be a little bit more water, and that affects not only what we're talking about here, but also agriculture. That's primarily where that's being driven. So again, I think it depends on where it is and where it is. And I think that the elimination of water or creating more access to water and creating different ways to deliver electricity, including maybe nuclear, are some of the things that people are looking at. Have you increased the loan loss reserves in the fund, and how much of the fund is invested in AI related industries or software that everyone is nervous about? Okay, well, the loan loss reserves in the fund are about where they were. They actually went down a little bit in 2025. Um, Most of the fund is not invested in AI related industries or software. Frankly, most of the fund is invested more in senior housing and other resilient asset classes. We like senior housing because historically, throughout different economic cycles, it has performed very, very well. So we have very limited to no exposure in AI related industries or industries that are focused solely on AI. Recently, the Fed has loosened the capital reserve rules for banks, which may mean billions more in capital that will be available in the marketplace. Will this create headwinds for deal flow in the WF income fund or opportunity funds? If so, how do you handle it? Well, um, as we all know, the Federal Reserve, when it's sort of elastic, right? You'll have these capital reserve rules that get tight, capital reserve rules that loosen up. Um, when a bank is deploying capital into the marketplace or has cheap capital to deploy into the marketplace, they tend to get a little bit more aggressive. So that may impact deal flow to some degree, but we're also a little bit different than how we approach underwriting and the types of deals that we do relative to a bank. So while banks may be competitors on one level, private credit, frankly, has come into its own over the last decade and has become a pretty important sector of the marketplace in terms of capital deployment. So I think that there might be some impacts, but I don't see that as being something that would be a catastrophic event or something that would be tragic for the fund. What is the AUM in the fund and how are the fees structured? Well, the WFP Income Fund has got about 75 million currently in the fund. Fees are structured. We have a 1.5% management fee. Um, in addition to the management fee, there are other costs associated with the fund, such as accounting and audit and things like that, that typically runs about 20 basis points plus minus. So all in, somewhere around call it 175 basis points is the cost of running the fund. What portion of the fund maturity is short term, and will there be an impact from lower interest rates for matured or renewed loans? Great question. The fund is all short term. Right now, we've got a weighted average maturity of 26 months. Some of those loans have what they call a yield maintenance provision, which is a protective measure. It's almost like a prepayment penalty that operates a little bit differently. So for example, if I've got a 9 months of yield maintenance and somebody pays me off in 6 months, I still get 3 months of additional interest. So it's a way to try to lock down and keep that yield in the fund for a little bit longer. But the fund operates a little bit bank-like when it comes to returns. When you're in a rising interest rate environment, as we put new loans on that replace the loans that have repaid, you're going to see a tick up in rates, but it's not a dramatic, sharp spike. It's going to trail up. And the same thing with rates as they start to drop. Lower interest rates will trail off and cause a decrease in the returns in the fund as we're replacing those with loans at lower interest rates. So there would be some sort of impact, but I do want to say that again, the interest rates on the coupons are disconnected from the NAV in the fund. So even though we'll see these fluctuations like we have in the past, the NAV in the fund has remained relatively stable or has been stable. And that's how we're going to be managing the fund from that point forward. So direct answer to your question, if market rates go down, we're going to have to go down with those market rates in order to be competitive and get good earning assets for the fund. So we'll see a little bit of a trailing down. Conversely, if interest rates remain flat or go up, we might see a little bit of a tailing up on interest rates as well. Okay, we're going to give it another second. Thank you. Got a compliment from one of our long-term investors. Thank you for the compliment. We appreciate you. We appreciate your investment with us. Thank you for entrusting us. Again, we thank you for that. Um, with that, what I'm going to do is I'm going to wrap it up. We do have our contact information on the screen, investments at wilshirefp.com. You're also free to contact us at 866-575-5070. We encourage you to ask questions, to explore what's going on in the marketplace. We're a resource for you. And again, thank you for joining. We appreciate it. Enjoy the rest of your day. Thanks.